Hello, everybody. This is Noah Rosenblatt, and we are here for a state of the market conversation, sales and rental market. And I got three powerhouses here. I got Ryan Serhant, reality TV star, author, and power broker of Serhant the Brokerage. Thank you so much for coming. I got David Mondrell, executive vice president of Corcoran New Development. Thank you for coming. And I got Adrian Savino, director of leasing and development at Living New York. Thank you, sir, for being here today. And guys, I want to just start off with a quick overall with what's going on with the market, 60 seconds or less. Ryan, we're going to start with you. Can you describe the current state of the New York City market?
I'm going to take a page from your book, from an article you put out yesterday that I think really nailed it, where you said we're in the eye of the storm. What I've been telling people is that this is the eye of the hurricane. In the spring and the summer, all people were talking about is the hurricane's coming. It's coming for the housing market. It's coming for all markets. It hit in September, right? We saw mortgage volume drop by 70%. We saw sales volume drop, listing volume drop, contract volume dropped in New York City by over 60% week over week, year over year. It was a mess. And then the storm kind of went out. October was okay. November has been great. And I think that we're going to get hit again come January. So that's where we are. So we need to buckle down, but take as much advantage as you can over the next 6 weeks.
Gotcha. 60 seconds or less. David Mondrell, what do you see in the New York City markets today?
This has not been a typical October, November fall, to be frank. And if Ryan, on the sales side is seeing, us being in the eye of the storm, on the rental side, if you just kind of look at where you are right now, the storm has passed. It's out to sea. It's in the Atlantic if you're here in New York. The sheer amount of true luxury product that we have been moving over the last 45 days, we are actually astonished about, where we are raising the price of high-end 2-bedroom apartments and 1-bedroom apartments across our entire portfolio right now, because we're seeing the absorption and the velocity that you just don't typically see this time of year, where you're seeing multiple trades that are at the top of the price point for individual marketplaces, anywhere from Fifth Avenue in the 70s in Manhattan to Astoria, Queens, to the Williamsburg waterfront, that you just don't really see. And now, I'm a little bit kind of nervous to kind of say we're past anything, just because of the sheer amount of job layoffs and cuts that you're seeing from tech companies and things like that, which really help the New York City marketplaces, on the rental side. But this is not typical what we're seeing, but really nothing has been typical, right, for the past 2-3 years, right? So I guess it's for the par.
Yeah. This is nothing about anything that's been going on recently is normal. We're in uncharted territory, unprecedented territory, and I think it's going to continue. Thank you for that. Adrian, let's go right to you. Right off the bat, 60 seconds or less, what do you see happening in these markets?
Sure. So I'll cover kind of the non-luxury rental segment. We are seeing more of a return to normalcy in that part of the market. After summer peaks, and we saw such a summer peak this year. Call it May through September. Things are starting to slow down a bit. That's typical year over year. There is a slowdown in the fall. So rental rates are kind of coming down. We're starting to see concessions jump up. We're starting to see whether it's OP, whether it's 1 to 2 months free. A lot of our landlords now are offering that to get a lot of these rentals back to the summer cycle. So they're avoiding the winter rental season. That's kind of a commonplace thing. But yeah, we're seeing people kind of continue to push that, and demand is kind of flatline for the season.
Okay, good. Thank you guys for that quick 60 seconds or less. Let's go right now to questioning. David, I would like to start with you. Can you give me a quick what's going on with the status of the luxury rental market, and potentially how does New York City stack up against other cities?
I think we've all kind of learned, all of us being in the business for many years now, that New York City is as resilient as it comes. Everywhere we've been through, myself, I've been through 9/11, we've been through the financial crisis, we've been through a pandemic, all things that none of us really ever expected to be through, right? And each time we continue to not just bounce back, we always bounce back at record rates. And as Adrian just mentioned, we're coming out of a summer and really a spring where we sat here and said, how long can this last? I mean, the numbers that we were getting over this spring were just unrealistically high, and they were outrageous. And we came back to earth in the summer, and we saw it, starting in May. And I remember talking to a very large client of ours, a REIT, and they were like saying, well, that we're seeing a little bit of a slowdown. And they're like, what are you talking about? Like, everything you read says that everything is going nuts, and rents are at the highest ever. And I go, yeah, but things are starting to slow up, and they did. It was just too high. Now we're still only off maybe 5 to 8% off of those highs, give or take. Things are, and I think there was a little bit of a pause. I think what's happening is, I think the sticker shock of, one, inflation here, especially here in New York City, where everything's more expensive anyway, and the inflation kind of settling in, where everywhere you go is a $6 iced coffee, and people are saying, okay, I've downsized. I'm going to downsize a little bit. I'm going to save a little bit of money and kind of reset my monthly costs. And as Adrian's saying, we've been transacting again. So we had a little bit of a pause. It slowed up a little bit, and we found kind of where the market is, where we can move product. And we've had a really strong November, similar to Ryan, I think you said, with sales. We've had a really strong, and then we've seen this kind of, and that's just across the board. That's all different types of product, anything from a studio to a luxury to high end, really, really, really big one bedrooms at the same time. And then you're seeing this push now, which we, in theory, expected, where as rates rise, people coming to the sidelines that would be typical buyers, and they are they're renting. And then in some of our high-end Manhattan properties, people who are either in contract to sell, they've been in contract for a couple of months, or just closed on some of their properties in Manhattan that they've sold, are renting as well. And they're not looking to jump back in to be another buyer. They're renting. So now we're starting to see, something a little bit more typical, and things that we saw during, it's been probably 15 years since we've seen this sort of happen, where these folks that can afford to buy are actually just going to be on the sidelines, mainly because of rates, recession talk, and economic slowdowns, layoffs, and people are a little bit more on edge, I guess, with certain things. But it's so obviously being a renter is a little bit more flexible. And we're seeing this push towards luxury, and on especially on the 2-bedroom side. When the 2 bedrooms for a period there, we were having a difficult time to lease. And if you went back a year ago, you couldn't find a 2-bedroom in New York City to rent. They weren't anywhere. Now, is this a factor of rates? Is it a factor of companies requiring folks to return back to the office, so they don't need that home office in the 2-bedroom anymore here in New York? It's probably a little bit of both, and such. But New York City rebounded very nicely from the pandemic. We all know that, and it's all as well. And a lot of talk about everyone going to Florida, but there's, still, as people are still going to Florida, and God bless them, we are seeing people return back to New York, because there's really nothing like it, and it's a steady trend of people who left and are coming back.
Yeah, the city is busy. So David, is it safe to say that the luxury rental market has had its shift, albeit seems like a small one, 5 to 8% was, I think, the number you mentioned, and we're no longer in active decline on the rental side?
It could be, I don't see it right now, right?
Okay.
Now, to Ryan's point, and I agree with him, it is really, I am not going to go out and say where that slip from the high that we had probably in May is over, because there's just too many companies scaling back workforce, especially on the tech side. I am concerned about the tech side and these job layoffs. And I'm not just talking about what's happening with Twitter. That's an anomaly. That is a different type of situation, right? Everyone's fixated on that because it's Elon Musk, and it's a very, everyone talks about it. Everyone has an opinion. Everyone's laughing about what's going on over there in all ways, shape, or form at times, right? But when you have companies like Facebook and Google and Amazon, and these folks, when these folks come into our buildings, they're coming in with 6-figure starting salaries, right? And they rent apartments anywhere from high-end studios to 1-beds. And when those folks are nervous that they may not have a job, they're starting to scale back. And that's the concern as we go into 23. Right. What happens with that particular demographic? And then at the same time, you have to be concerned about the financial industries in the financial, because of the financial markets and bonuses, things like that. and attorneys always seem to do well. So the attorneys are always around renting. But the tech side of things in terms of our demographics is the one I'm most concerned about. So I'm not ready to say we're bottomed because we just don't know really the effect.
Right.
And the other thing is just with inflation, people are, say in New York City, just too expensive. And if companies are allowing people to, not everyone has to go back to the office, right? So if they are allowing people to move to places like Texas and Florida, everything we read about, right? And they can keep their salary the same, and with tax benefits and different costs of living, people are going to try it out. And so we're going to have to see. So I'm not sure to say, I'm not going on the limb yet.
Okay, gotcha. So there's still a little uncertainty there. Thank you for being honest and giving a straightforward answer. Always appreciate it here. That's the luxury rental market. Now I want to shift to the luxury sales market. Ryan, I got you over here.
Yes.
Could you give me any type of insights, Ryan, on the luxury sales versus the non-luxury sales sector? How are you seeing the market perform both above and below the $4 million threshold?
Below $4 million has taken an obvious hit, right? Rates have affected everybody. If you need a loan, people are now sitting on the sidelines. For one, buyers are saying, okay, for the same price per month, I can now only buy a 2-bedroom at this price point and not the 3-bedroom or maybe 4-bedroom that I thought I could afford. You know what? I'm not going to move. And then you have sellers who are now locked in, who are saying, I want to upgrade, but I can't afford the monthly payments to upgrade. Plus, my current place has a rate at 2.8% or 3.2%. So why would I sell? And so now you're seeing a boom, even more so than during COVID, on home renovations. People renovating, people doing flex walls. Like we've got $7 million apartments where people are putting up flex walls to add another bedroom, right? Which is just mind-boggling to me because the cost per month, if you need a loan to go and buy a $10 million apartment, is a lot, right? Like we were just talking to someone yesterday who wants to buy a $1 million apartment, and the monthly charges in the building are high, and for what they could afford to buy and own a 1-bedroom was going to cost them like $14,000 a month. Why would you do that, right?
Yeah.
Now, north of 4 million, okay, cash is king. There's major luxury deals that are getting done right now because cash is king. For example, we're doing a deal right now in the city, all cash. The asking price is $66 million, and my buyer's getting it for 46 because he's paying cash. He can move quickly. The seller's nervous about, oh, where's the world going to go? I don't know what's going to happen. And so guess what? There's a $20 million discount. Now, was it ever worth 66? I don't know.
Right.
Is it worth 50? Yeah, probably. And so there's a lot of great opportunity out there right now, which is why you're seeing some very, very heavy prints left and right, throughout the news. But like, remember, everything comes down to inflation right now. This year is all about rates. The real pain isn't going to start until early next year. I don't know how long it's going to last. I don't think it's going to last that long. But until you get rates above inflation, you can't quell inflation. So I don't think we've actually seen the slowdown yet. You've only started to see some cracks, both in major markets, but also in consumer confidence. So I think it's just the beginning, and we just have to find opportunity. Where there is volatility, there is opportunity.
Yeah. And I mean, I'm so glad that you brought out the fact that sellers are not considering selling and upgrading because of potentially their rate lock that they have in there. I look at inventory in Manhattan. We are not surging by any means. We're actually rolling over right now. And I think buyers are a little confused because
you have people who are the typical seller right now is saying, I can't actually afford to sell. I don't care what you pay me. Where am I going to go? And how much is it going to cost me per month? Unless you are a pure cash buyer or you have a great banking relationship or you're buying down points. So, for example, we work with a lot of sellers who are now doing seller financing. I haven't done a purchase money mortgage since 2009. When I was doing 99 John Street for TF Cornerstone in 2009, 10, and early 11, we did seller financing. It was a 5-year IO deal, okay, because Fannie and Freddie had pulled out of the building, and so it was a complete catastrophe, and it was a 5-year balloon, and then you would just refi, and they were really, really hard, but we had to learn as real estate agents how to do loans. Whereas all my predecessors who had grown up during the boom of 03 to 07 were quitting because they were like, I don't know how to do this. I just want to walk people into sales centers and get paid. We're now doing those again. Banks are getting really creative because they're down 70-75% for the year. And you've got some big developers like Xtel, right, who's doing a 2% rate rewind, who's buying down buying down your loan by 2 points for the next 3 years to kind of get you through the current pain. And so there's plenty of money out there. You just have to be creative with it to make deals happen. And I think a lot of people look at the negativity and say, ugh, okay, things are going to be bad. It's not true. Let everyone else say that and go and find the options, because there's crazy ways to put deals together right now.
Yeah, Ryan, real quick before I go over to Adrian, on that creativity point, are you seeing sellers on just regular resale deals here? I'm not talking about the super luxury sector, but just regular 4 million and below kind of deals. Are you seeing sellers and buyers negotiate points directly as part of the transaction?
Yeah, it's part of it's two things. We negotiate points as part of the net sale price. So it's not like the seller is paying someone's mortgage. It's saying, okay, this is what your rate is. In order to get you down a point so you can afford my apartment, how much is that going to cost? Oh, that's $27,000. That's $43,000. Okay, if I want to make a deal happen, let's do it. And what's interesting is deals that we put into contract last year and earlier this year are the ones that are having a lot of those conversations. Like we have a deal in Brooklyn that was, I think, $4 million or just under, that went into contract earlier this year. And she never even thought about, rates. And now she's having a hard time affording the apartment. And we adjusted the price by $100,000. And in her mind, she's going to take that $100,000 and put it over into my mortgage payment bank account to get the deal done. And the pushback to the seller, who was real angry about it, and no, I'm not rates, this is that, they're underpaying. It's just showing data and saying, actually, they're not underpaying. Looks like they're paying market rate for 9 months ago. And if you lose this deal, the apartment will come back on the market. Affordability is much tighter. Here's where we think you're going to trade. So it's having those tough conversations with people.
Yeah, that fear of losing the deal. Think about what you're going to have to do, start all over if that goes away. Thank you, Ryan, for those insights. Adrian, let's get right over to you. I'm going to bounce back to the rental market. Adrian, listen, if you can give me some clarity right now, there's two things I would like to ask you. Clarity on concessions and OPs, whether or not those are coming back. That's one element. And then if you could talk a little bit about what term leases are landlords agreeing to. Are they looking to lock in longer term, or are they trying to keep it short?
In terms of the last year or so, we saw the power kind of in the landlord's hands. Low supply, there was a huge amount of demand. So, there was a lot of people, competing for a small amount of rental supply. We're starting to see those numbers balance back out. So because of that and kind of the season that we're in, typically fall, winter, is a bit, a bit slower. Spring, summer, a bit faster for the rental market. We're starting to see concessions creep up. Not crazy. It's not with every apartment. It's not every segment, but I think the segment that kind of ran away was the, just a step below luxury, call it $5,000 to $10,000 apartments per month are starting to give, 1 to 2 months free. Those 1 to 2 months free, are not coming without kind of an attachment to an overall lease term. Most landlords now are not wanting to kind of sign 12-month leases. They don't want to deal with this problem or inherit this problem year over year. So they're asking for, call it 15 to 18-month leases. They want to get this problem out to the summer, so it's no longer a problem where, again, things are typically quicker in the spring and summer. Higher price points are achieved, and there's more demand out there. So landlords are trying to incentivize what little demand is in the fall and winter to get out to the summer market.
Yeah, that's interesting. I guess that's what they want to go, right? They want to get that summer re-entry point next year. Can I just ask you quick, Adrian, what about the the lower end, the 5,000 and under? Are they seeing any types of concessions, or it's really just that 5 to 10 intermediate spot?
Listen, that's in terms of submarkets within the city, it depends on where it is. We're seeing lower Manhattan, core Brooklyn, waterfront Brooklyn still perform very well, especially under a certain price point. Those units are still in demand. People still want to live there. Everyone's looking for affordable, housing. So I would say that the concessions are typically applied to the higher end, but we are seeing those things creep up like we do every year.
So thank you, Adrian. I'm going to shift over to David really quick, David. I want to talk about 421 421A expiration, increase in filings in the first 2 quarters of 2022. Any details on overall supply and new developments, completion parameters? How will filings change going into next year?
There was a real big rush to get, the piles in. The deadline was June of this past year to drive a pile, or break ground on a project to qualify under the old program. And so we have been extremely busy over the past year and a half. Folks that were holding on to sites, trading sites, folks that were kind of just holding on and saying, okay, it's time to kind of build. Kind of either I'm going to sell it or build it. So we've signed up, I would say upwards of 12,000 units over the past year and a half plus, of new projects that are in pre-development, just because of those changes to to the 421A program, because there is a belief in some parties that it won't return, or it won't return, at least in a less favorable way than where it was prior. Now that's just my portfolio. Then you take that from all the groups that I compete with and peers in the industry, and there's going to be a massive amount of inventory coming to New York City. Starting at the end of 23, mid to end of 23, and starting in 24 through 25 and 26. And it's not just like one section. Like, we talk about Gowanus rezoning, and years past we have talked about the Greenpoint waterfront or the Williamsburg rezoning back in 2005. We're talking about throughout New York City. So there's going to be a lot of options for folks if rates, for rental product. Now that puts a downward pressure on the market, right? And it's usually handled in some way, shape, or form with concession. But concessions are a factor of the gross rent. So, we have other projects that are, they're rent stabilized, their gross rent is locked in. We're bound by rent stabilization guidelines on increases and all. On those particular projects, in those buildings, the tenant pays the brokerage fee, and there is no concession. The rent's reasonable. People know it's typically the newer buildings where the OPs are happening, and the concessions are applied. So it's really always I always said it's always a factor of what the gross rent is. That's where the concessions come in. But the inventory is coming, and it's going to come in somewhat of an unprecedented way, because it's going to be throughout the city at about the same time. Starting mid 23 all the way through to 26, depending on the scale of these jobs that are coming. Plus, you had the Gowanus rezoning, you had multiple rezonings throughout the city. You have new marketplaces in the luxury front, such as Jamaica Queens. The Bronx which has really picked up over the past couple of years in terms of planning, for permits and things like that, because of just land costs. And every marketplace, everything will be fine. It always is, right? Everyone said when downtown Brooklyn was getting all this inventory, 8 years ago plus, they're like, oh, it's never going to get filled. It always gets filled up. We all know that. But there's a short-term pains that we all kind of work through a little bit, and that's all kind of factored in when we price. And then you go upward and onward. And then, some of the insiders that we've kind of talked to, we have a couple projects where they did not qualify for the previous program. And so we've talked to some of the industry experts and put our clients together with some of those industry experts, and they believe that the program is going to come back in some way, shape, or form next year. The question is how, favorable or not it is. Then we're going to deal with construction costs, and you're going to deal with, what makes, can you build in the city, under this new program. So there's a lot of uncertainty with that, but there'll be some product coming for sure.
I mean, are you worried about this? I mean, I know you said you're not too worried. Everything will be okay. I mean, it seems like it's needed. Is that correct? Like this product is needed. I mean, I think back the last 4 or 5 years, 2018, 2019, 2020, 2021. I can't imagine development was ramping up during that period with everything. I mean, before the pandemic, we were going down, with rent regulations and the mansion tax and other policy-driven kind of recent things that were going on. I feel like the new development pipeline has been down and out and tight. Is this the first time that we're about to enter a wave, a period of years where it's going to start ramping up again? Is that what you're saying?
I think this is the first time we're going to see it on a scale where it's really all 5 boroughs. I mean, we're working in all 5 boroughs. And at the same time, you have New Jersey continuing to explode from a development standpoint, pushing further and further in, from the Gold Coast at the same time too.
Yes.
So that's another factor here in terms of supply that's continuing to come, because people start, they started building in New Jersey, and then all, because of rent regulations here in New York, so many of our New York developers started jumping over to New Jersey. And you look at pipeline reports, for our Jersey that we work, we alone have 8 projects in Jersey, my group. I've never solicited anyone. I never knocked on a door. It's all referral based or existing clients and such like that. So we look at these, I look at my pipeline reports for these different marketplaces I'm working in Jersey, and it's like, I know him. I know him. I know him. These are all guys from New York, and folks from New York that have kind of jumped over to, New Jersey. So the inventory is going to be, it's tri-state, and then you have
Yeah.
like this whole push that's kind of pushed further north, like Westchester and Rockland, Connecticut, and such, where there was this kind of, because of the the rent laws once again here in the city, and things like that, and people have kind of said, okay, I want a different experience after the pandemic, and I want to be a little bit more suburban. So you have White Plains and those marketplaces, so you have inventory there as well. This, that the change in the 421 kind of really affected a lot of different places. So this is a little bit unprecedented. The good thing is, I tell these clients that we've kind of, where we've started kind of working on in the past 6 months on these jobs, is most likely when they come to market, based upon how recession cycles work, we'll be coming out of recession. The recession hopefully would be past us if it does, depending on how deep it is and et cetera. So we should be okay. That's the key with this whole thing. I am not nervous, because we've been through this so many times, either personally and corporate new development and corporate as a company. So the key is for us, every building needs to stand on its own. Every building needs to have, needs to be well planned. It needs to be very thought out. It needs to be designed for the demographic. Those days of kind of just putting it together and saying, oh, it's a rental, and kind of cutting costs and such. Those folks, they'll do fine, but they're going to be a low cost option for folks. They're not going to achieve the high dollar initially. They're going to have to wait for a massive upswing in the marketplace. And the buildings that we, in all of our buildings, we put as much time and effort into our pre-development. I really believe we're one of the best at this, and really kind of defining not just the demographic, giving the demographic what they want and what they need from a practical standpoint, non-gimmicky. That's the key. Gimmicks, they don't work. People ultimately won't pay for it. You got to give people things that they want. New Yorkers want rooftop pools, right? They don't want indoor pools in these rental buildings. They don't get used, right? In any building that we've worked on with an outdoor rooftop pool, it crushes. I can't tell you how many buildings that we work on that have outdoor pools in the boroughs, like, in Brooklyn, let's say in particular, where we're ripping through $100 plus rents, $125, truthfully. And this stuff is not really out there that people talk about, because we don't really kind of go out there and really kind of just dangle it to the press, say, look, we got $125 a square foot, at this building. But that's the stuff that people want. And that's the kind of train of thought we take as a group when we're going into these projects, knowing that this inventory is coming, and we need to develop amenity packages that really cater to that demo.
Yeah, that is excellent. Circling back to you, Ryan, I'm going to go flip back to the sales market. Listen, I know that buyers are gloomy. I know that buyers, their perception is probably altered a little bit. They look at what's going on outside of our market. They see markets down 15, 20, 25%. They look at Manhattan, same macro circumstances are going on around us, but we're not down 25%. I hear a lot of agents calling me, telling me, no, my buyers wants to wait until January, February, when prices are down further. This catching a falling knife perception.
Never works.
Where do you see things going, and how would you tell a buyer, or what would your rebuttal be to a buyer that says, I'll just buy next year, or when the prices are down lower?
Because here's what's going to happen. Once you think prices are down fully, you think it's at the bottom, you try to time it, okay? What's going to happen is that the media is going to write about it. Other people are going to talk about it. And once that happens, it's already over. Okay. And once that happens, every seller is going to tighten their belt. So you're going to say, oh, 1, I'm not going to sell. 2, I'm going to stop negotiating, right? I've already lowered my price enough. That's where we are. And then you're going to end up paying more. And it's what happens every single time. It's like that famous Men in Black line when Tommy Lee Jones and Will Smith are sitting out there on the park bench, and Tommy Lee Jones says, a person is smart, people are stupid. And that's exactly what happens in all markets, right? Every market you have the innovator, the imitator, and the idiot. And the idiot typically is surrounded by a bunch of other people. And that's why they buy Bitcoin at 60,000 because, it's going to be the greatest thing in the world, right? Or they invest in FTX because that guy's smart. Look at his hair. He must be a good guy, right? Or they buy all. Listen, I made it a policy for us in 2020 and 2021 because I didn't want anyone to get in trouble. I didn't want to have anything in writing that was pushing anybody. We made it very clear that anyone who was buying, after the COVID bump, we told every buyer, just so you know, these prices seem a little inflated. Just so you know, right? This bidding war is not normal. Just so you know, do you really want to buy this? I just want to make sure. Last thing I need is COVID sellers coming at us right now the way they are now. And they'll come at us hard next year. And they say, why did I buy? Why did I spend that much? Why did I do this? It's already happening outside of New York City. It's starting to happen here as well. But I think that as we have these conversations, you can have great negotiability again. It's exactly what you asked for as a buyer. All the buyers that didn't buy last year and at the end of 2020 are like, I'm going to wait for prices to come down. I'm going to wait for more negotiability. Like, did you think that was going to happen with no caveat? Did you think things were just going to be like you're just going to have your cake and eat it too? No. Lower prices come with higher rates. Okay, and then higher prices will come with lower rate. It's all about the monthly payment. And just do the math. I'd rather buy now, negotiate way harder, get concessions, like load up on the best deal, pay a higher rate for 2 years, refinance all the way down. I'll refinance 12 times. There's certain banks, I think, what is it? First Republic, maybe another bank. No, guaranteed rate right now. If you do a deal right now with guaranteed rate, they'll give you a free refinance in the next 2 years if you refi. So they'll cover the cost to refi. So if rates come down, you want to refi, they'll just do it for you for free because they want you to lock in now because they know, right? They know everything is short term. So I think this is short term pain for long term gain.
Yeah, I mean, and you just mentioned that, and people are negotiating points as part of the whole transaction price, and that's helping to bring rates down. I mean, there are creative things to do. I'll just add, when I think about a down cycle, right? You got a deceleration, you're going down. And then you have a bridge, and then you have a receleration, right? Yep. And that bridge is just the gap, is the market actually changing from deceleration to receleration, right? That's really the bottom. Is that what people look for? Here's the thing. We're kind of at that bridge right now. It looks like we've stopped falling and the market's coming back a little bit. Ryan, you mentioned, yeah.
Now, sorry to cut you off. There was a great article that came out yesterday. It was a photo of Jamie Dimon, right? And it was this $1 billion investment into housing. Okay. Did you see that yesterday? It was in the Real Deal. It was all over. Yeah. Right. In the spring, Jamie Dimon comes out and says an economic hurricane is coming. Batten down the houses, batten down the hatches, right? Everyone freaks out. He says that. Markets move. Pricing starts to come down. Okay. Then what's he do? Did it work? Guys, did it work? Yeah, pricing came down. We are investing into discounted real estate. That's exactly what happened. I don't understand how this is information for people. So you can either, sit back and be scared. And when you're scared, you're predicting what your future is going to be, which seems pretty scary. Or you can be positive and speed into the curve, just like a NASCAR driver. Like they don't slow down at the curve, they speed into it so they can come out much faster. There's great deals out there right now. New York City specifically has withstood 9/11, the great financial crisis, Hurricane Sandy, COVID, and every single time we come out that much stronger.
Long-term capital management.
Yeah, exactly, right? Savings and loan crisis, everything, the 60s, the 70s, whatever the hell we're going through right now.
Buyers, here's the thing. Buyers want to wait for the recovery. They want to wait for the recovery. They want the stability, the clarity of the recovery, but they want the fear pricing of the deceleration into the downside, into the bottom, right?
Yeah.
You can't have both. If you're decelerating into the bottom, that's the time when you're going to get that fear trade. That's the time when you're going to get that seller to hit that gap down bid. That's the time when you're going to get that huge value and those huge concessions when the seller's scared and they don't know how far it's going to go. If you wait until it's
Negotiate through
all over,
fear. In the sales market, that's what you do. Figure out what is the buyer afraid of, what's the seller afraid of. Figure out what those fears are. Play to those to negotiate and get a deal done. Right?
Exactly.
No one who
All
bought
right.
in New York City in 2009 regrets it. They're all angry about it. I remember doing deals in Long Island City and people were paying $650 a foot and they were mad. They were angry, right? They were like, we're overpaying. The New York Times said, kill yourself. It's the end of the world. Why would you ever buy real estate? And now they're like, I was a genius. Yeah, see, look, I was the genius in 2000. So be the genius in 2022 and early 2023. Or wait and overpay like everybody else.
Buy in a buyer's market. How about that? Buy low. All right, very simple. Keep it simple. All right, we got 2 more questions left. We're going to wrap this up. I'm going to throw this out to Adrian or David. All right, risks and potential opportunities in the New York City rental market. I want to talk about both. Do you guys see the challenges and what potential opportunities to offset those challenges do you see? Any one of you guys want to take a stab at that?
I think I think both of us should. I think what I see is that I think the risk is, when you're developing a project today, don't underestimate the size that people are looking for now. Especially with the rate increases and what's happening, there's going to be a shift back to rental for a while here. How long that's going to take, I'm not sure. People are going to, you have the affordability side of things that Ryan's mentioned. And then people are going to want flexibility, especially here in New York with our political climate, with everything that we're dealing with as a city on multiple levels. And then you just have, the economic side of things where people are going to be a little bit concerned for a while. So what's happening is these folks want to be here in New York. They're not going to buy for a bit, so they're going to need to rent. And too many clients out there sometimes believe that they're too concerned about square footage size and price per square foot. What's happened is over the past 20 years, people are bucking up for larger apartments on the rental side. And we used to be the same way. I used to be the same way, focused on size, right? And we're seeing people step up to the plate and pay big money and high price per square foot for larger apartments now. And this is for ground up new construction. So new construction, a lot of times, if you're in family art, unless you're in like places like Tribeca, or if you're developing in Park Slope and like traditional, like say family oriented marketplaces, like, Brooklyn Heights, maybe, right? In those marketplaces, you're gonna look to trend to build a little bit higher square footage wise, because you're gonna try to cater to families and things like that. But people are paying for size because they're not going and they've been doing it for a bit here, because places like, say, for example, like Brooklyn, or places like Astoria, Queens, and such, because they want to stick around and need some space to move around and grow a little bit. That's going to continue, because we don't know how long these rates are going to stay where they are. And if rates stay above 5, it's still going to put a hamper on sales for, like Ryan said, for that $1 million buyer, that million to say $2 million buyer and such like that. It's still going to hold them back. It's not going to, and when we'll ever see 2 3/4 again and 3%, I don't know. So that's the one thing that I would say is, don't be so locked in buildings small, right? Because there's a whole market out there that's looking for larger experiences. Adrian, what about you?
Yeah, agreed. I mean, in terms of new filings for construction, we're seeing just over 750, which is going to represent about 60,000 new units coming on the market. It was a huge kind of race to the finish line with the expiry of 421A. So from a new construction standpoint, there's going to be a ton of new supply coming onto the market. I think to your point, David, with regard to planning, kind of programming the buildings, we're seeing the amenity race kind of continue. So not to say that you need a pool, not to say that you need a basketball court, but flex office space, work from home opportunity, package room expansion to kind of continue to handle this e-commerce boom and stay at home. I think that the properly delivered new construction projects that are in core markets are going to continue to perform. So opportunity there for landlord. and then opportunity for the renter to, maybe take advantage of this kind of short-term blip in the radar. Fall, winter pricing, concessions to, what we spoke about before. And then as the supply kind of rebalances, I think things will, pull out of this little downturn and we'll continue to kind of, rebalance and average out.
Yeah, very good, very good stuff here. Thank you very much, Ryan. We're going to end with you with this last question. You're so good with this, Ryan. And I know a lot of agents really appreciate your wisdom when it comes to this topic. But how could agents in such a challenging, complex market today, how could agents grow their business, or any challenges or any strategies that they could do to get bigger and to get better coming out of this?
www.sellitlikesirhan.com. Sign up for our courses.
Proven course.
That was teed. That was unfair. That was teed right up.
Join our membership. Work with the coaches, the mentorship. It's all, to be completely honest.
Give me something.
It's real help. That's for anyone listening. You should check it out. It's the greatest sales training program in the history of the world. That said, I would really use this time to buckle down and goal plan for 2023. If you're listening to this right now, 2022 is done. Okay, whatever you're going to do in the next 6-5 weeks, whenever you're going to do it, it's going to happen. You have a lot of time now to really focus on your goals for 23. Think about how much money you want to make. Break it down then and say, okay, then how much do I need to sell or rent? And break that down and say, okay, then how many people do I need to meet? How many people do I need to meet every single day in 2023? Because that's your job. If you're an agent, if you're a person, right, in this business, your job is to generate leads. That is it. So how are you going to generate more leads next year than ever before? What networking events are you going to go to? What groups are you going to be a part of? Where are you going to go? What can you do that's creative? And think about your personal brand. Because the way you're going to make the most money in this business is if you wake up a brand instead of waking up a broker. That's how you wake up with leads in your inbox. That's how John Smith at 1 a.m. while he's on Street Easy or Zillow is like, actually, who's that guy I keep seeing, or that girl that she keeps doing those videos? I see her on TikTok. Let me just reach out to her. Let me see if she actually does this. And then boom, there you go. $2 million client, $4 million client, right? I would focus on those things, and that can really, really start to dictate the power of your career and put you on an upward trajectory. And think outside the box for next year. Let everyone else be afraid. Let everyone else be scared. What kind of creative marketing can you do that'll put you out there, right? What can you do? What kind of deals can you do? What kind of investor deals can you do? Maybe you start looking into commercial a little bit. What parts of the city, like in 2009, I'll just end with this. When I first got into the business and I was doing rentals in Koreatown and kind of all over the place, it was very hard for me to get into sales because who would work with, no, I wasn't from here. No one would work with me. I didn't know the difference between Broadway, West Broadway, the East Broadway, I had no idea. But in Long Island City, in Queens, for $800,000, you could get a 3-bedroom, and there were great concessions and great deals. And those deals were actually getting done. And so drop the ego. And I would say, you know what? I'm going to take the 7 train every day. I know I live in the city and I want to do business here and I read about it and it'll be way cooler. I'm going to take the 7 train every day, and I'm going to sell as many $600,000 to $900,000 apartments as I possibly can. I'm going to learn how to sell, and I'm going to really build that. And that's how I got my first project. That's how we met the Alleghenians, TF Cornerstone, and that set me up forever. Had I not bit the bullet and said, you know what, that's what I'm going to do. I'm going to go to where the market is instead of trying to bring the market to me, I would not be here today. Those opportunities exist right now for so many people, especially newer agents.
I love it. Just do it. What are you doing today to get those leads tomorrow? And go out there and do it. Don't talk about it. Don't have analysis paralysis. Don't sit there and write it all out for 5 months. Do it. Give yourself some goals and go and do it. I love it. Thank you,
can I
guys.
ask Ryan a question before we jump? Ryan,
absolutely.
We don't have this information at Corcoran.com, right? Corcoran.com. So I'm wondering, if I go to the website you mentioned, do you have a tutorial on how I can do my hair as well as you do yours? Because the guy from FTX, his FTX guy's hair is just, I just can't get it that high. It's just, I've tried.
We have a special course just for brokers like you who are so
Wonderful.
successful. They don't have time. to do their hair. They're just so successful. You got what'd you say? You have 92,000 units you're bringing to market this year.
102,000, sir.
Yeah, exactly. I'm on projects with Dave, and the developer always look at me after I give my statement, and they're like, "Let's see what Dave thinks." They always push it back over.
Why do you say
he's
that?
way more thoughtful than I am.
That's exactly no. The project we work on together. That's exactly what they say to me. They go, "Well, Ryan, what will you think now?" Like they play us off each other, and then they decide what they want to do anyway, right? Our clients.
That's actually true.
Two
And then they don't do
minds.
either. And then they're like, "We chose what you both didn't want." We're like, "Great, awesome."
I love it. Two great minds. I love it. By the way, if you guys want to have your hair just like Ryan, it's shapeitlikesirhant.com is where you're going to go find that right there.
Exactly.
Ryan Sirhant, thank you for coming in. David Mondrell, Adrian Savito, this has been fantastic. Thank you guys for sharing your insights in your local sectors and your wisdom and these nuggets of actionable insights that I hopefully the audience can take some action on and get some business out of. Thank you guys so much. I am Noah Rosenblatt from UrbanDigs. Have a great day. We'll catch you next time.
See you guys.
Thanks,
Thanks, guys.
Thanks, Jen.
Cheers.